Hello everyone, Siobhan Ashby here. I'm North East Wales' newest resident advisor and I'm here to introduce myself and to give a quick market update. Before I get started, just a general advice warning. This doesn't represent financial advice or specific advice. However, please do get in touch if you'd like to have a chat about what's going on in your personal situation. Now, before I jump into what's happening in the market, it would be remiss of me not to talk about the topic that's hot on everyone's minds. Coronavirus has not only had a high social impact in recent months, but has certainly impacted market movements and trends for the year. So let's get started by having a look at how COVID-19 has developed over the last few months and what that means to us right now. Researchers are testing 36 vaccines in clinical trials on humans, and at least 89 preclinical vaccines are under active investigation in animals. Scientists are working around the clock to have a quick, safe and effective vaccine produced by early next year. The danger of this is that vaccines typically do require years of research and testing before reaching the clinic, so there's no way of knowing what the long-term effects will be. Now, as you can see here, there's some phases down on the chart. So phase 1 involves testing a small number of people to understand appropriate dosage and safety. Phase 2 involves testing hundreds of people to test a wider demographic, including children and the elderly, to understand what the effects are on different bodies. Phase 3 involves testing thousands of people to see how many become infected compared to volunteers who receive a placebo, which can determine if the vaccine can protect against the coronavirus. Now, China and Russia have reached limited approval without waiting for the results of their phase 3 trials. Experts say the rush process has very serious risks, and an additional challenge of approved vaccines coming from communist countries is that there may be a concern regarding where the data has come from and whether the data has been skewed. At home, Scott Morrison has pledged a vaccine being developed by Oxford University will be distributed with free access to all Australians once ready and available. However, global biotech leaders have warned that there are many hurdles to get through before we're at that phase and has put a cautious timeframe of mid-2021 for emergency use availability. This highlights the lack of caution with China and Russia and indicates that unfortunately we are still a way off. Now, more specifically at home, there have been approximately 25,500 cases of coronavirus in Australia, and currently there are just under 4,000 active cases. Peak number 2 of the graph here suggests that even if we get on top of this again, we need to show more care in how we're coming out of the phase. We're unlikely to move back to stage 1 lockdowns until a vaccine is reached, and recent months have demonstrated that we can't contain virus outbreaks in stage 2. Curve 2 also proves that this can come up really easily again, which can have a big impact on markets and unemployment rates. The flattening of Curve 2 is a positive sign, though, that we can reduce numbers when we're all in this together. So, what exactly does this mean for our markets? Some good news, the All Ordinaries has bounced back in recent months, gaining 1,800 points since March, which is a positive sign for investors. Whilst it hasn't recovered back to pre-pandemic figures, investors with a long-term outlook could see this favourably as they're purchasing at a 20% discount compared to 6 months ago, resulting in saving on investment. The bad news is that unemployment is continually rising, which is a concern. The total unemployment levels have reached a 22-year high of 7.5% and is looking to continue to increase. Now, the reason this is particularly bad, aside from the social aspect, is that unemployment means less free cash in the economy, resulting in less spending, which is of course bad for business and results in lower share market returns. Something interesting is that despite the increase in unemployment, household spending is actually similar to the pre-pandemic. Looking at the trends on spending by consumers in Australia, this could actually be a bad thing. Discretionary spending has increased significantly due to available household cash from government stimulus packages, including earlier superannuation payments and the deferral of essential spending, for example, deferral of payment on mortgages, rent and utilities. This means that the true economic impact may not be seen until government support is withdrawn. If we refer to the graph here, You can see down the bottom that online gambling and food delivery are actually the biggest spend categories relative to the latest week versus a normal week, which is indicative of this concern. And again, if we have a look at the superannuation spending, what people are spending their superannuation withdrawals, 64% is on discretionary spending. So this is a bit of a concern in terms of how Australians are spending their money right now in the midst of this crisis. Moving into some positive news. Market volatility has reduced significantly over the last few months, indicating that we're starting to find a new normal, which is really positive for investors. Now, the volatility index, which is the graph we're looking at right now, indicates the movements in share price. So the lower the volatility index sits, the higher consumer confidence is in the markets, and therefore the more likely investors will start getting back in. So as you can see from the graph here, it's sitting at approximately 23 at the moment, which is down from 80 in March, which was an all-time high. So the lower risk environment that we're really after to see a sense of normality is around 8 to 15, which you can see pre-pandemic. So there is still a little way to go, but the downward trend is certainly optimistic. One of the bigger challenges that we need to remember is this is a health crisis and therefore more difficult to predict in terms of the duration and the uncertainty of what will happen in particular in the short to medium term. So, what are going to be some of the key signs that things will start firing up again? Once again, to reiterate, this is a health crisis, so case numbers do need to fall to a level where the economy can fire again and stay there. A lesson for Victoria is that we can expect much swifter and perhaps more localised lockdowns in the future to ensure that small suburb-based or even building block breakouts don't grow into state-based lockdowns. Additional indicators will be a rise in employment rates, which will be aided by the removal of lockdowns and restrictions, and the removal or easing of stimulus packages will indicate government confidence. Government isn't likely to pull the rug out on stimulus assistance unless people can afford to get by. Further increases in total spending will also be a good indicator of economic recovery, in particular once government stimulus packages have been removed. So you can see by this graph here that the weekly index of consumption per person, 100 is considered normal, and currently total spending is sitting just below there at about the mid-90s. So it has certainly picked up again from April. However, we do need to see it continue to rise a little bit more to have a little bit more confidence that we're getting out of this. In conclusion, overall, we're starting to see a sense of normalcy in the markets with share prices up and volatility dropping off. This may be indicative that it's a good time to be investing long term, but certainly as things remain up in the air, it's a poor time to be dabbling in markets. Safe to say though, it's going to be fascinating for investing over the next few months. That's all from me, guys. I'm very excited to meet you over the coming months, and if you have any questions, you're of course welcome to get in touch with me or any of the team at Northeast Wealth. Thanks so much and have a great day.